Hello, and welcome to this special conversation hosted by the CFA Institute Research and Policy Center. I'm Mona Naqvi, Managing Director for Research, Advocacy, and Standards here, and head of the RPC, the Research and Policy Center. I'm thrilled to be joined today by Roger Urwin, who is Head of Investment Content globally for Willis Towers Watson and a longtime friend and partner of CFA Institute. And we're going to be talking about the topic that's on so many asset owners' minds today, and that is TPA, the total portfolio approach, of which Roger has been a leading architect over the past several decades. Roger, welcome to the podcast.
Delighted to be here, Mona.
Well, Roger, I'd be remiss not to start with your incredible background and contributions to the investment industry over the last several decades. You are known to many, but there are maybe some listeners out there who know your work, but maybe don't know that you're the man and the genius behind them. So why don't we start by walking us through your career to date, how we got here, and your role within the investment industry?
That's a big question. I have been around for a long time. The first part of my industry background was in consulting. I stepped away from that to do asset management. I was head of quant at an investment organization in the 1980s. That was Gartmore. In the end, it became Henderson. But it actually kind of gave me a lot more of a clue as to why I love this industry. And it is because it's just so full of fascinating perspectives and people, and it's been a thrilling challenge all the way. So I started up the WTW investment consulting business in 1989. I was employee number one, and I took it through to a position where it was fairly close to about 1,000 people as at 2010. And my work there was as a global head of a business, and it was contributing a lot of thinking, thought leadership, and client stuff. And then at that point, I started to maybe run out of steam a bit, and I thought, I want to commit my time just to clients and just to thought leadership. And that's what I've done for the last 15 years. At WTW, we founded the Thinking Ahead Institute, which many people know as one of the big think tanks, actually trying to create new avenues for the investment industry to pursue in the next coming years. And there's so much change that it's a very resonant place for new thinking to be occupied. And when I look at it, I've got this track record really of being around at the early stages of a number of the industry firsts, as it were. So I was very involved with passive management in the early stages. I started up the target date funds and the life cycle designs in the 1980s. But, one of my proudest things is that I was very involved with total portfolio approach in the mid 2000s. There were several funds thinking about it, pursuing it, and in the end, putting into their arrangements. And since that time, I've been a contributor to the forerunners of the RPC. And what we now have looking forward is the opportunity, I think, for the CFA Institute to produce some very original research around future of finance and thought leadership themes. And TPA is one of the big themes that's out there at the moment.
Absolutely, couldn't agree with you more. I mean, it feels like we are on the precipice of a major structural transformation for the global economy in general, I would say, but very specifically also for the finance industry. And whether it's disruption through artificial intelligence, the sustainability transition, or the growth in private markets, it really feels like there are so many things happening. It's a confluence of so much right now. And I do know that TPA is one of the tools that can help investors kind of make sense of all of these seismic changes. But before we get into TPA, maybe we could start with the basics and where we've come from. So why don't you walk me through the basics of SAA, strategic asset allocation, what purpose it served, and maybe where it's worked well and perhaps where it's worked less well. And then we can discuss how TPA fits into all of that.
Yeah, brilliant. And I always think that actually going back and remembering history is crucial. You can't really get today's context without thinking about where we've come from. So So the big factors here were that performance measurement came out of the early 1970s. We didn't measure performance regularly or consistently before that time. That created a sort of league table orientation to funds in the 1970s, 1980s when I was kind of starting out my craft. And as a result, funds were very much caught in a very circular race to just do the best they could without regard to their circumstances. And it was very obvious that pension funds with certain types of liabilities should not be compared with different types of insurance funds or endowments or other types of organization at that time. There needed to be some customization to do with circumstances. And that came along in the tail end of the 1980s into the 1990s with particularly the advent of asset liability modeling, which created the the route to how SAA came about, because an asset liability model basically was able to suggest a policy that was matched to the specific liabilities of a fund. And before that, it was too inaccurate, I would say, a process, and it wasn't really fit for purpose. So now I did a stack of work in the 1990s with these funds. So these funds generally had not customized themselves, hadn't got SAAs. They put SAAs in place throughout the 1990s. It was a decade of a lot of change in the investment industry. And it was, to me, doing Trojan work to make things just more effective and efficient and fit for purpose. And I didn't think other than it was actually exactly the right work for the time and the right process for the time. Fast forward a little bit, and I was getting a little bit twitched about it because the flexibility that was involved with SAA was limited and markets were starting to move rather more fast. And it was at that stage when CPP and Future Fund in particular said, actually, we'd prefer more flexibility. We can arrange our board to do a somewhat different job. We can do it in a different way where we don't have to be quite as anchored to a benchmark.
Hmm.
So benchmarks, SAAs are one and the same with having a strong benchmark. TPA is much more about multiple comparators and absolute return orientation. So at that stage, the absolute return argument started to emerge, and the flexibility that came from a TPA started to emerge, and those funds started up, and they have not looked back. There's never been a thought about those funds, including now New Zealand Super, which was the third to join the group. GIC then joined, that was the fourth. So those are the four names that you get when you go back to the TPA origins. Yes, I was around, I was talking to all of those funds at the time. But essentially, the TPA started to tick away in the background. No one really paid a huge amount of attention because they were happy enough with an SAA. So essentially, fast forward to today, we just have a different set of conditions, and there's more reason why some of the SAA restrictions and frictions, I kind of use that word quite a lot. And I did want to reference the work of Grinold and Kahn in 1989, who created the fundamental law of active management. Basically, the the efficiency and information ratio you can get from investment propositions does include an allowance for how much there are constraints, frictions that hold performance back. And SAA has several frictions. So that we could talk a bit more about.
Yeah, certainly. I mean, by way of some of my background, I spent many years at S&P building index strategies. And one of the things that came up often was obviously the purpose of a benchmark, the purpose of an index was to, as it says in the name, benchmark the performance and to represent and reflect the world as it is, so that we had a way and a mechanism to communicate the value add of a given strategy relative to something universal and foundational that can be used for end beneficiaries to truly understand how they've performed in the market. Now, do you feel that TPA loses some of that in that SAA's more rigidity creates a level playing field that is particularly in the pension fund space where, these are very conceptual and nuanced, technically proficient terms that perhaps as you communicate the strategy to the ultimate beneficiaries can get lost in the mix. And if you have this more flexible approach with TPA, do we lose some of that underlying universality to help communicate the value add?
Yeah, that's very interestingly framed, and it's correctly framed in my view that the SAA actually does have a degree of comfiness in it. Comfiness through a board's lens, but
Yeah.
also comfiness through the end investor's view. As in, actually, we go back to the 60/40 thing, obviously we don't have 60/40s anymore. We have much more sophisticated SAAs, but by and large, you kind of know a bit where you stand just through those very figures you see. So the benchmark actually leads you to understand what to expect. And that's actually an asset for some parts of the ecosystem, but it is a little bit of I'm going to say liability to flexible investing, which is therefore ultimately, what people are looking for when times get tough, markets change, complexity kicks in.
Yeah. So how is it that TPA equips investors to address and deal with complexity in a way that SAA can't?
Well, it's actually a bit contested, which is the more complex of the strategies. So essentially, really, investment maturity, investment funds have matured. They get smarter over time, but they also kind of get a bit more muscle bound to some extent. It's actually quite an interesting journey. But essentially, when you look at it through that lens, the flexibility that comes with the TPA does afford new opportunities. And so, the heart of TPA, it is alignment to goals, it's best ideas, and it's dynamism, which isn't meant to be tactical asset allocation. It's more like a dynamic opportunity, which is open to a TPA on a continuing basis, not a timetabled
Mm.
calendar-based opportunity. So it's basically that what you get from a TPA is the opportunity to refresh your portfolio a lot more than you would in an SAA. So those are assets that seem to point to more investment skill getting through. And that's where I'll reference again the fundamental law of active management, because essentially aligned to goals is that point about friction. TPA doesn't really have a friction. It's set up to be the most efficient portfolio you can come up with. SAA will always have a degree to which the returns are downgraded because you build tracking errors in and benchmarks in, So
Yeah.
there's bound to be a bit of a downgrade of your skill, So you can have the skill, but you can't make the skill work as hard in an SAA. And then best ideas is clearly opening up the opportunity to as much skill as you have. That's an issue because TPA is not going to make a poor investor better. That doesn't make any sense. And then the last one is this thing about dynamism, which is actually about breadth, you see. So dynamism gives a TPA portfolio more breadth than an SAA will ever have. And breadth is a princely quality in that equation because it's statistically a fact. This is really an axiom that you want to put as much breadth and diversity into your investment policy as you can, because diversification is that only free lunch that we ever get in the investment industry.
Very fascinatingly put. I mean, as you were speaking, it reminds me, I wondered, do you think this is a fair characterization to say that, in its simplest terms, SAA is on one end of the spectrum providing accessibility, but TPA provides flexibility. In that SAA is easier to understand, easier to communicate, more consistent,
Mm,
more universal.
mm,
So it absolutely plays a role
mm,
for how the investment industry works in terms of it's a level playing field. It's a way in which we can communicate consistently and universally to a system that is ridden with information asymmetries, but it
mm,
simplifies by design to help us make sense of that. Whereas TPA is inherently more agile, more dynamic, more responsive to the conditions in the market in the real economy that are inherently complex, but
yeah,
therefore in that it loses the accessibility afforded by SAA because of its rigidity. And so in some ways it's a fundamental trade-off. Do you have accuracy or do you have understanding or accessibility in some way? And then
yeah.
it's up to the end investor or up to the strategy to decide which of those is more appropriate in a given case.
Yeah, by the way, Mona, I love the way you put that, and it was very, very accurately put. It was actually, of course, this trade-off between the simpler version, which is actually what I call basically comfy governance, right? Against efficient investing. I don't think there's any doubt that you've called out that TPA is set up to be investment efficient, but maybe it's rather stretchy governance as a result, you see.
Yeah.
And therefore, that is a choice. And really, what we have in the asset owner space across pension funds through to sovereign wealth funds, etc., is quite a complex governance setup, which is other people's money being covered by different bodies that coalesce and have to work together. And not all of them see the construct the same way. You know, that's kind of interesting. So on a practical basis, you've got to have comfy governance to some extent. If you've got uncomfortable governance, you're not going to get anywhere. And
Mm.
so one of the big challenges of TPA is making sure that the mindsets converge on something and that there is a level setting of expectations and there is more teamwork, really, across the organization. That's implied in a TPA relative to an SAA. SAA, you have your buckets, you have your different parts of the portfolio. They operate a little bit more independently in silos, whereas the TPA is really trying to unlock marriage value across the whole portfolio.
Yeah, it very much is a systems thinking approach to identify the space in between these various different concepts, which is why I wonder, maybe that's why it's so hard for some folks to get their head around because it's just inherently complex, and you're basically saying there's no shortcuts to the complexity. You've got to wade through the muck, as it were, and avoid, get out of your comfort zone from your comfy governance. And if you're really going to navigate disruption in a period of, systemic risk and opportunity, this is the tool to do it. And maybe in the past, the relative stability of the global financial system, and I say relative, obviously, there's been periods of major instability, but by and large, to your point around the underlying prevailing philosophical orthodoxy around modern portfolio theory and all the other things that you mentioned, where those legacy models haven't necessarily been challenged. But as we enter this new era of disruption and technological innovation at a pace that we've never quite grasped before, maybe that simplicity won't get us far enough. And actually, this is somewhat existential in order to make sense of this complexity. Is that a fair characterization?
Again, it's very accurate, but it's a lot of things, right? You layered them on top there. So if I try to unpack that, there's a couple that are really, really important. It is basically that this complexity is weighing heavy on an industry that built its past practices and basically foundations up around physics envy, right? So for that reason, I think a model that's more sensitive to the system, the ecosystem, is really important. And indeed, that's realistically reflecting the idea that the fundamentals in market affect and are affected by our behaviors as investors. That is the concept of reflexivity, which I'm kind of going to go out and say I think there's about one person in a million who understands what I'm talking about when I talk about reflexivity. It's a really important concept. Soros did great work in narrating it. I recommend his work on it, but it's a really important concept which marks the difference between ecosystem thinking and the classic versions of modern portfolio theory that we know and love. And I'm not throwing them out. This is not the same as how the Copernican turn worked out. So we got it all wrong. We thought that the Earth was the center of the universe, and Copernicus showed it wasn't, and every calculation had to be changed. You know, you had to completely reset your view. We can build off modern portfolio theory because it is just a simpler version of what is taking place within the ecosystem. And I think that's the ambition for the investment industry, is to get wiser and sharper around that. And you used the phrase earlier on that risk models have to go wider, softer, longer than they have before.
Yeah, it reminds me of this idea of, you know, how the poles shift, the magnetic poles, the north and south pole of the planet Earth shift every few millennia. So if you have a
Yeah,
compass and it's pointing north, true north,
yeah.
that's going to continue to work for a long time, and it's going to guide and direct any navigation. But every so often there is some upending of the system around us that requires you to recalibrate. The compass will still point north, but will it get you to the intended place where you want to go? And so I wonder if what we're facing at the moment is this upending of the system where MPT and SAA, they were fit for purpose in an era of relative stability when the poles were aligned with the tools at hand. But every so often something comes along and that requires us to rethink things. And it might be why I suspect on the margin, TPA versus SAA doesn't produce very different results. And so you may have some skeptics that say, well, what's the difference here? The old system works perfectly fine. And that's maybe because it's been in an untested period of stress. And it's kind of like, how does it perform under the stress test, which may not be happening all the time, but there is every so often this once in a millennia event that does create that upending of the system and the stress on the model, in which TPA may or may not be superior. But I suppose that's the vision that you're championing. Is that correct?
It is correct, really, that I'm very I work incrementally with the funds that I advise, so it's not like there's any scrambling to do things completely differently. This is a multi-quarter type process that funds are looking at to move forward, be progressive, just become more sophisticated.
Mm.
I think sophisticated is better than complicated. I think sophisticated often has complexity attached to it, but sophisticated is something where you can get an edge and you don't want to, I think, be caught too much with yesterday's practices. And so in this area, we've created a bit of a difficulty because SAA had all the sort of apparatus around it. It's what I call a meta construct. You can't see SAA as just an investment thing. It is an investment thing, it's a governance thing, it's a risk thing, it's a sustainability thing, it's a people thing, you know, all of those things. And so is TPA. So from that point of view, we're not changing one thing. Change one thing, you change everything. You know, you've got to actually see this as quite a big deal to move to something new. And it's in that area where I think it's been a relatively slow moving diffusion of this innovation that has been out there for a while.
Let's talk about the people for a moment. You've been working with a lot of firms trying to help them evolve their processes. What does it mean for the people and for the skills and the mindset, and what challenges are you encountering, if any, in the adoption and widespread implementation of TPA? Are the incentives set up in the right way for the investment profession? Is that all it is, or is it a cultural issue? What would you say has been the biggest barrier to the mind shift
Yeah.
among the people that would be leading this change?
Well, firstly, I think you've got to say that if you don't shift minds on it, then you're really going to have an unsuccessful change process. So you actually do have to very much put people first in this change. And so from that point of view, the mindset that we've had has been built around the idea that individual departments or asset classes are where people do their work. There hasn't been a look across the portfolio as much as there might have been in that context. People are happy enough in their silos, and then the incentives have also aligned with performance within asset classes against benchmarks. So people respond to incentives. The rest is commentary. That's one line definition of economics when you get down to it. It's pretty clear that needs to be changed if you're going to be successful with TPA. So you're creating a change of mindset. Usually it's called first team mindset. Patrick Lencioni wrote the book about five dysfunctions of a team. He used that principle, which is when people spring out of their department or whatever, they will need when they come to the first team, which is the overall total portfolio team, they will need to leave their baggage behind. They will need to be oriented around one goal, which is to get the best performance out of the total fund. And therefore, they will need to reflect on whether or not their asset class is the place where new capital should be applied. So that becomes, point number one. You're actually working on a different objective. And of course, if you haven't changed the incentives, you're in trouble. So incentives are crucially oriented around really that any of the variable comp has to be kind of put in a currency where it's total fund outcome that actually is what pays people. So a vertical is a deep domain expert. We have a gazillion deep domain experts in the investment industry. They do their job brilliantly, but they've got to respect the idea that their work doesn't spring up in isolation. It has to be put in the context of the whole portfolio. And that makes them need to be a little bit more T-shaped, capital T. They've got to be vertical, deep domain, but they've also got to be horizontal here with respect to understanding what's happening elsewhere and understanding where their portfolio fits vis-a-vis these other parts of the organization, and indeed vis-a-vis other parts of the organizational functions, including this very important growing bit, which is to do with technology. So individuals have to be more T-shaped, capital T. It's a really important concept. Previously, they were all right being I-shaped, deep domain. Now they've got to be more T-shaped. And it's really then coming through a little bit more with organizational changes as well, where the organization is looking to people to be a little bit less caught by the hierarchy and a bit more able to contribute to the networks. The network, which starts with investment committee contribution, but can be other places as well. And in particular, you've got, in a sense, a new vertical entering the equation, which is how technology has to be seen alongside investment specialization and expertise.
Yeah, I mean, you took the words right out of my mouth. The next thing I was going to say as you were speaking was this just seems so timely with the disruption that AI is bringing to the workforce. We at CFA Institute, are grappling with similar questions around, we're a credentialing body that's designed to equip the investment industry with the highest levels of integrity, trust, and ethics. But the very foundations upon which the financial industry is based on are being challenged. And so questioning what skills are needed to equip the profession of the future in a world dominated by artificial intelligence and the intersection of it with human intelligence, which I know is a phrase that you've championed. I'd love to dig into that. But as you were speaking, it sounds as if, we have, or we will have, more of a reliance on machines to help us do potentially some of that deep analytical work, but then the connections and the patterns and the implications are what perhaps the human brings into the equation, the human in the loop. It's that broad spanning expertise that a machine led by prompts can only do so much of, but it's again, those spaces in between the prompts and the spaces in between the pre-training and that kind of quintessentially human cognitive capacity to envision something that isn't written down on paper, and to imagine a scenario that I think machines, at least from what we've seen so far, are less capable of doing. And so do you think that TPA, coupled with AI transformation and questions around the role of the analyst, the role of the investment professional in future, in some way kind of solves I don't want to call it a crisis, but that anxiety that so many of
Yeah.
us have around what role will we as humans play in a
Yeah.
world dominated by AI?
Yeah, for the foreseeable future, I'm a big optimist that this is good news, but I can't see that far into the future. And on that basis, we have to be a little bit more concerned about the longer term future, because these machines are super smart. I mean, I think everyone's been shocked as to how much they've contributed already to our own operational efficiency before we've kind of changed the parameters of how we do our work, you see. So yes, I have championed a phrase which is very, very simple. It is that HI, human intelligence, times artificial intelligence, AI, is a very powerful proposition and clearly comes out well ahead of HI on its own, AI on its own, or anything that is the summation of those two. It's the combination that matters. And that implies that the role of the investment professional will migrate over time a bit away from the discretionary decision making that they've been extremely good at, but not consistent enough at as an aggregate of the population. They're going to have to actually migrate more towards really designing governance in a different sort of way and making sure that they can mark out the investment process in its different phases. So really unpack everything that goes into an investment process at the moment, but allow some of the functions that go into that investment process to be handled by machines that can do it better than the human, you see. So it's obviously that's where the product term comes in. So essentially, when you look at it through that, the big, I think, dimension of change is that we now have an intelligence ecosystem change, which is pretty substantial. That is to say, previously data has been out there and it's been handled really in a sort of rough and ready, higgledy-piggledy way. But we actually have to become much more systematic about really harnessing more data than we had before. A lot of it is unstructured. We have to pass that data, PARSE. We have to push that data towards some sort of decision useful shape, which can be addressed and used in a very decision useful way by the collective intelligence of our organizations. Now, collective intelligence here obviously has a certain amount of it that is based on the intelligence that's coming from machines, but the vast majority of that is then individuals making judgments on the back of improved intelligence on risk factors, on return trade-offs, on everything that's moving, and doing so in a much more responsive way to the fast-changing conditions that we encounter. So from that point of view, every day, stroke every week, stroke every quarter, there are better portfolios that can be created under that type of paradigm if you've got the combination of consolidated real-time data, you've got decision useful analytics really built in there, and there are a number of sort of outside providers that can put that on a plate in front of organizations. By the way, if they've got the consolidated real-time data, which is, the weakest link at the moment. And then lastly, you've actually got an element where you've actually got to make sure that the engagement around some of these factors is properly built in, because often you've got an asset owner, asset manager interface that makes the thing a little bit more complicated. More complicated, but actually more open to unlocking value as well.
Yeah, absolutely. I mean, the level of complexity and the interrelationships between all the players is another dynamic, yet still that has to be managed as well. We started this conversation by talking about how the legacy models have served well in a period of relative stability. We're now clearly entering unprecedented disruption. But one would hope that at the end of the light at the end of the tunnel is that at some point there will be a new status quo. No, who's to say whether that's 10, 20, 50, 100, 150 years into the future? I don't know when that will be, when our superintelligence overlords potentially take over. But at that point, will TPA's relevance cease to exist if the universality of the system has reached a point of singularity, and therefore the role of the T-shaped thinking becomes redundant?
It's actually, beyond my pay grade to answer that, actually, Mona. But I think the key aspect of it is really managing to a horizon that is long, but I think it's very difficult to manage to anything longer than, I'm going to say, 10, 20, 30. I've got a client that I work a lot with, New Zealand Super. They've been working on their reference portfolio as though it's the risk exposure for the next 30 years. I like that. I think it's well done. I don't think you could anticipate anything like the uncertainties that are going to manifest in the next 30 years. But on the other hand, it's the right discipline. But from the point of view of TPA, I think the methodology of TPA actually has got more resilience than the SAA had. The SAA was put together kind of, I think, a little bit more with a bit of sticking plaster at the time, which is really trying to manage to the circumstances of the industry, strong boards, not so much in the internal teams. Now, asset owners have a lot more internal capability. They can work with more degrees of flexibility and with fewer constraints, you see. So TPA is set up to be relatively resilient stroke robust. I use those words slightly differently. I see robustness more in the portfolio sense. I see resilience more in the organizational sense. Both of them have to be covered here. So when you actually look at it through that lens, you're asking almost for this impossible perspective around where the speeding up and speeding up, which is a fact, is going to lead to. And I have my concerns about that.
Sure. Yeah.
I can't
We all do.
really sort of, I think we should do, so from that point of view, we are introducing into our ecosystem, at the planetary level, a lot more systemic risk than we had before. That systemic risk doesn't really have a past, but for sure, it has a big future. And so some of those risks are apparent, not necessarily fully discounted. Climate risk, I would say, is apparent but not discounted. But I think that elements of the artificial intelligence proposition, which carries so much promise for society in the broad, but also the investment industry in our own narrower base, I actually feel that the risks are difficult to pin down. What are the externalities of AI? It's clear it's got an externality around energy use, but I think it may be a little bit more insidious and latent what type of things are out there with respect to those things. I think we were on a more confident wicket saying TPA has a bright future. I'll stick to that.
Oh, I think, these are questions that I'm just playing around. I know that, I mean, I doubt that we'll ever reach this singularity, or at least if we do, it'll be well past our times. I hope anyway. So we won't have to worry
Well,
about that.
the
But
only
I
thing
do
I
think,
hear about the singularity, by the way, Mona, is that those that kind of understand the gig there are a bit worried that it's certainly within our time, put it that way.
well, that's true. Well, it remains to be seen. But
Yeah.
I mean, it poses a broader question around, you talked earlier about value creation and the fundamental rules of active management. And we've you also talked about real-time information. In other conversations, you and I have talked about this notion of, well, what does the role of the investor obviously is to try to maximize risk-adjusted returns and to create value. But some of that is speculative in that it comes from market moves. And then there are other fundamental underlying economic reasons that push out the production possibility frontier that are genuine innovations and growth of the pie rather than just reallocating the slices. In a world where we have potentially real-time dissemination of information and no information asymmetries, how do you think the investor can continue to create value? Is it a better scenario because we're more focused on genuine value creation, or are we maybe creating a system where because of universal knowledge there can be no winners and losers, and so the notion of investing itself as a zero-sum game potentially becomes challenging? And is there a role for TPA and all of that to help identify those new synergies and new opportunities where perhaps SAA would be more focused on a broader picture, including the speculative gains?
Yeah, it's a spot on question again. And really, it's a question that I think is very, very central and a bit misunderstood by different types of analysts who look in on it. That I think, therefore, the worry about investment being a zero-sum game, I think, is a little bit overplayed. It obviously is in certain areas, but in other areas, there are tremendous positive sum investment decisions to be taken. So from that point of view, I'll just give you a simple example. Obviously, diversification itself. If you actually start with a basic reference portfolio, which is now what TPA suggests you should do. So listed equities and bonds starts the process off, call it 70-30, whatever. The opportunity to build a better portfolio return per unit risk by introducing other risk drivers, return drivers into the portfolio is actually fairly considerable. That is a skill thing. That is a positive sum. So all investors can benefit from a certain amount of diversification in that type of context. Not every investor can benefit from shuffling the property rights around listed markets. That's obviously correct. So from that point of view, you actually got to make sure that you play your cards more substantially in the area where positive sums can exist. And one new area of opportunity and ambition should be stewardship, you see. So at the moment, we allocate less than 5% of our resources to stewardship, more than 95% to capital allocation decisions. And I think there's scope for more resources to be allocated to stewardship, including systemic stewardship. So that becomes more the gig here, that we actually recognize that we're not managing a completely stable closed system. We're managing something that is part of a bigger system, right? And that bigger system can support our future returns, or it can be a big drag on those returns. Think of climate change, those externalities. So net zero investing was conceived and is, in my view, delivering something where it actually contributes to the reduction of the externalities on the investment industry, because it starts to chip away at the sort of return losses we would have if climate change ran amok, as it were.
That's right.
So the investment industry is set up to address that. Not everyone sees it the way I see that, but I think it's very clear cut that there's opportunity in what people are now referring to as system level investing.
I
So
mean,
that,
it kind of reminds me of, you
yeah,
have these universal asset owners who, which is very pertinent in the context of indexing. I mean, you can't beat the market when you are the market. So your only opportunity is to reshape the behaviors of the market itself, subject to the external conditions, be they externalities and whatnot. We're going to have additional conversations, Roger, as you know, and in future versions, I'd love to get more into the specifics of how an investor can practically take the steps to start to implement some of this. But before we go there, can you just explain to me whether there might be circumstances in which both SAA and TPA could work alongside each other? Are they fundamentally mutually exclusive? How would it work from a from a resource allocation, construction, and time spent, the actual specifics of the governance, are these things potentially consistent with one another in different parts of the portfolio, or are they inherently a substitute one for the other?
Yeah, so this is an important idea to plant and to make sure people recognize that really it's not binary between SAA and TPA. There's different versions of it, and a number of the versions actually include a future for the SAA within a TPA. I don't. It might sound a tad confusing, but it isn't. Trust me. One of the levels of TPA that we talk about in our work, that we is of course WTW Thinking Ahead with clients, is top-down TPA where an SAA is still around. So you don't actually get rid of it, but actually you want to de-emphasize its benchmark quality. You want to actually use it as an influencing factor to the investment thinking. So it's a little bit of a change of governance and it's a change of emphasis. So I think that becomes important. So I don't see SAA and TPA as completely at odds with each other, but I do see the need, therefore, to be very sensitive to individual circumstances, to boards' views, beliefs, and preferences to work through these issues. The boards actually have a tough job here. They have to reconcile a lot of conflicting stuff. Nothing in investment comes across without a contest. You've got a contest for the ideas, as it were. So I see that going on into the future. I see really a lot more spectrum stuff where people are a bit one, a bit the other, and they're fine with that. I cannot see anything other than overall more movement towards TPA principles. I think it's baked in now. The reason I say that is really because 2025 was a year where we jumped the chasm. People were previously saying, I don't know what I'd do to get to TPA. I might like the argument, but it's too difficult. But actually, in 2025, it's been a case of watching a few exemplars do great work to jump the chasm and be out there in a better place. And I'll call out PGGM and CalPERS as two organizations that are examples to us all.
And historically ones that have led the charge on many initiatives around which the rest of the
Yeah.
industry tends to follow suit. So I'm sure there's something there. You had mentioned to me in previous conversations that, over the years, you've been working on this for decades. It was a drip and now a bit of a drip drip, and now it's a full-blown fire hose. Well, thank you, Roger, for spending the time on explaining the big picture concepts of why this is. And I think, as I mentioned in our next conversation, we'll dive even further in, and we'll try to equip the industry with what they need from a practical lens to actually go about taking their first steps towards TPA. And to your point, making sure that it's positioned alongside the other tools to try to contextualize the big upended disruption that we're facing, but in a way that makes sense and is accessible. And I know you've done so much research both with CFA Institute and with others, of course, Willis Towers Watson, Thinking Ahead Institute, and there's some research that will be coming out soon to help contextualize this even more. But are there any kind of parting thoughts you'd like to share for our listeners beyond what we'll get into next time when we actually speak about the specifics of implementing this stuff?
Well, I'm thrilled that there's much more coverage of this subject. I think much more awareness has come through this year as well. So all I do is to encourage this principle of level setting. You have to do that with every fund. Individuals have to come together with a certain, I call it scaffolding, really. They've got to actually understand enough of the principles here. And by starting out with the level setting of that knowledge, you get a long way. That's why it's so important for CFA Institute to be on the case as it is and trying to help with the education of a difficult subject. This is not at all straightforward, but it's truly rewarding. And, I love my work in part because we seem to be making progress on this.
Absolutely. Well, I'm here with you along that journey. We're going to get out of that comfort zone and wade through the muck, and we'll figure it all out together. But for those of you at home listening, we hope you've enjoyed this conversation. Like I said, this is the first of a mini series in which Roger and I will wade into that muck together and join us on that journey, and hopefully engage with us on this topic. It is something that is inherently complex. We invite you to join us, to participate in our society conversations across our member network, or reach out directly to myself or Roger or anyone at CFA Institute, and we would be happy to have a conversation with you. But thank you for your time. Thank you for listening, and we'll see you next time.